Howdy, Jacob here. Today we're looking at Barrett Business Services in the professional services industry. 856 billion market cap on 732 billion enterprise value. They provide business management solutions for small and mid-sized companies in the United States. Incorporated in 1965, headquartered in Vancouver. Growth is not incredible. 636 million in revenue in 2014 to 1.07 billion in 2023. But you're looking at fairly consistent growth. We are seeing it slow down though. From the mid 2010s, there were some double-digit revenue growths, and the most recent 3, 4, 5 years, it's averaging low to mid single digits. But great return on invested capital, pretty common for a professional services industry because it just doesn't take much money to make more money. They just give more money from clients and put it into their investments. We see a dividend paid hasn't been increased in the last 4 years, and it looks to be well below their earnings per share, so they can likely very much afford that. Their gross margin is quite a bit higher. Operating margin was fairly consistent outside of this looks wonky 2014 year. You're looking at about a 4 to 6% range on the operating margin side. For balance sheet, we do see 71 million, about 152 million cash-like products with zero long-term debt, zero short-term debt, just 15 million in their capital leases. So not a whole lot of interest-bearing debt for them. So very safe on the balance sheet perspective. Cash flow statement shows, as expected, again, little capital expenditures, but they are growing. So we are seeing some reinvestment. Majority of cash is going towards share repurchases and a dividend, with the dividend paying out just under 1% yield. And on the payout ratio, that $8 million is definitely not substantial. I would say maybe 20% of their 5-year average free cash flow, and that's including some negatives here, and then share repurchases with a bunch of the rest, essentially. So let's start making our own assumptions here. On the revenue growth side, I think I'm going to stick with that mid single digit range. And then they do have a high return on invested capital, but they are just giving it back to shareholders through share repurchases and dividends. They're not necessarily reinvesting a whole lot back into themselves. And it is asset management, so there's only so much you can really do there. And so I would say from a PE standpoint, at the end of 7 years, I feel pretty comfortable with 13 there. For margins, do pretty close to averages here. Let's do 5, 4.5. And then for share change, 1% for them would be about $8.5 million. I think that 3% would be about 24, 30, about 33, including their stock-based compensation. So let's incorporate that. They haven't changed their dividend in 4 years, and although they can afford it, I don't mind them just buying back shares that are hopefully maybe in the next 7 years. Sometimes it'll be cheap, sometimes it won't. They'll buy back less when it's not as cheap and buy back more when it's cheap. That's what you want them to do. We'll see if they actually do it, but I think I feel comfortable with this. So this is saying that about 15% goes to dividend, 15, 20%, and then a 50 to 60 goes to share repurchases, leaving a little bit for acquisitions that make sense. They don't have debt to pay down, but then a little bit for reinvestment. So I think I feel pretty comfortable with these assumptions, and we're saying that needs to fall not quite in half, but pretty darn close before you get to the return we're looking for here. I think what I'm seeing from the numbers, it's a great company, just currently a little bit too much for me, given the fact that it's growth, current valuation, future margin. So one that I think I'd be pretty comfortable owning it. Not one that screams extraordinarily sexy to me, but I think it is a good company. Just not at the right price for me right now. So hopefully you enjoy the video and have a great rest of your day. Thank you.